Venture capital and early stage private equity investments in the past have not been very accessible to the retail market. But this is set to change following incentives created by Section 12J of the Income Tax Act. This now allows 100% of the capital contribution to registered funds to be tax deductible. Jeff Miller is a director of Grovest, one of the companies licensed to operate under the new dispensation, and he joins us in studio to explain the concept. Well, this is quite remarkable in terms of the history of South Africa. Take us through exactly what it means before 12J, Section 12J in terms of the Income Tax Act.
Thanks, Bronwyn. Firstly, thanks for having me. Section 12J is a new dispensation under SARS which allows investors to invest in venture capital companies, which are companies defined or qualified companies with assets below 20 million, and that the investor is entitled to 100% deduction of the monies into that fund. That also not only to individuals, that's companies and trusts as well. That means whatever, if someone has taxable income of R1 million, they invest 200,000 Rand, they'll only be paying tax on 800,000 Rand, allowing the 200,000 Rand being 100% deductible.
So Jeff, this is fantastic because it's, I guess it's the first step in really encouraging investors to be able to invest in venture capital by giving them such great tax incentives. Besides the initial capital contribution, what else? Are there any other tax benefits that investors receive in the course of investing in these funds?
Well, I think firstly, what it does, it encourages the average investor to have now access to this asset class, which historically they've never had before, because it's only available to high net worth individuals and family offices. But what it actually does, and conventional wisdom says venture capital has historically been high risk, but by now getting the tax benefit, you're actually getting 100% of your capital work for you, but only 60%, assuming you're at the marginal tax rate, at risk. So it now equates the fields, investment fields, in terms of risk-related rewards. Now, normal tax benefits would be we would return any capital surpluses by way of dividends, which would be taxed in the normal case in the hands of a company.
We've got this fantastic idea, though, the opportunity which you really see, because the money can be deployed into companies, as you say, that have assets less than 20 million. Just take us through what your intention is with this pool of capital that you're going to be getting from investors. What sort of companies are you going to be looking to invest in?
Well, firstly, we're looking to raise 100 million, and it's our intention that we would deploy that 100 million over between 15 and 20 companies over the 3-year cycle, which is allowed in terms of Section 12J. And the intention in terms of our investment criteria would be that would be at different stage type businesses. So there would be early stage businesses, seed capital, Series A and B, which is like mid-stage capital, together with growth capital businesses over a blend of different industries. So in other words, that we can have portfolio, a wide range of portfolio risk, so that there's no single investment that's going to to weight the portfolio.
What do you expect the take-up to be from the retail investor out there, or do we need a little more education in this space?
I think, being the first out there, I think it is going to take a little bit of education, but now we've just recently launched, and the response has been fantastic. Onto our website, we've had lots and lots of people who are looking to get our private placement memorandum, which should be out next week. So it's looking good, I must say.
We've got, just to get and really educate, I guess, our audience around this, is a minimum investment of 100,000 Rand. Is that the
yeah, correct.
criteria?
That's the criteria. A sophisticated investor, 100,000 Rand with a maximum of 20% of the fund. Assuming that we raise the full 100 million, investor could invest 20 million, and this maybe would relate to maybe a pension fund who now can invest 10% of their capital into private equity and venture capital funds.
And the investors get the tax benefit in the year they make it. But in terms of the cycle, investors really need to be aware this is a process that takes a number of years. You mentioned you've got 3 years to deploy the capital that you receive into the portfolio companies. And then obviously you're looking at, as I understand it, about another 3 to 5 years to harvest those investments. So it's not an investment that people can get into and out of very quickly.
Now, venture capital by its nature is a medium to long-term investment. as soon as we have realized an investment, the capital or the capital proceeds or surpluses will be returned to investors by way of dividends. So we see there will be a flow of funds throughout the process. But by nature of the investment, it is medium to long term, and investors should know that upfront.
What kind of sectors are you going to be putting cash into?
I think just by nature of the type of asset that you can only be below 20 million, they're going to be low capex, highly scalable, disruptive, tech, mobile. There's green businesses. I think the intention is going to be over a whole range of different businesses at different life cycles, but because of the 20 million cap, post investment, they're going to be low capex businesses.
Jeff, you've got, I'm sure, a lot of people interested. Just talk us through the regulation and the governance around this, because I'm sure people are very interested in getting exposure to this. I presume you're going to be audited by SARS to make sure that you're deploying the capital in the way that they've agreed. But tell us about some of the other governance structures you have in place.
Okay, firstly, to be approved by SARS, you have to be FSB registered as a Category 2 provider. Which we have, then get SARS approval, which we have. There's obviously compliance that needs to be done, so there's compliance officers. We allow to issue tax certificates for the amount invested by investors in the year in which the money was made. SARS obviously will be policing that. And obviously our compliance, we have to see that we're up to date, obviously, and comply with all the regulations.
You've got an investment process in place. You've got an investment team in place. I want you to tell us about first of all, your experience and some of the people on your team that are going to be managing these investments with you.
Well, my background is I'm a chartered accountant by profession, but venture capitalist, entrepreneur by nature. Have started in excess of 30 companies. I have quite a successful history. Probably the biggest success I had was a listing of BrandCorp in 1997, which was later taken out by management buyout by Ethos for a substantial amount. But my whole life I've been investing in early stage businesses or starting early stage businesses, and that's where I believe I'm a startup specialist, and this is where I want to play. I have a very solid board. Malcolm Siegel is our chairman. Malcolm was historically the managing partner of Grant Thornton. Then went on to have his own private equity fund. Was with Sasfin, and subsequently left. He's our chairman of Grovest, and he sits on the board of the IDC on the investment committee. Jeff Livingston, who was very instrumental with myself in the listing of BrandCorp. He has he was, like I say, instrumental with BrandCorp. He was a founder of Net1. He currently sits on the board of Advotech. And he himself, in his own personal capacity, has been an active venture capitalist and private equity investor.
So as this board, are the responsibility for the investments? Obviously, you're going to be involved screening a lot of these things. Does it then go to your board to approve investments for the fund?
Yeah, so there's a management company, Venture Capital Management Services, which is managed by Malcolm, Jeff, and myself. Then who will do all the sourcing, the vetting, the due diligence would be presented to the board of Grovest, where we have independent directors sitting on the board, which would then be approved by an investment committee, and assume that we pass all the necessary governance in terms of the investment committee, the investment will be made. But what will happen is that we will put a manager or one of our members of our management committee or from the management company on all the underlying boards. And this is to give a bit of a grey hair, experience, and obviously assist them with strategy and plug them into our networks.
So traditionally, this has been quite a tough space for companies operating, small companies trying to get finance. You're going to be doing a bit of a bridging function there, aren't you?
Well, I think that is the biggest problem in South Africa for early stage businesses. I mean, the access to traditional sources of funding from the banks is limited. They want asset-backed securities, they're not happy to take the risk, etc., etc. So that's the one issue. And the second issue is just how to navigate the business world. And I believe that Grovest will, plug both of those gaps. Is one, we have the access to capital, and we obviously have lots and lots of experience that we can take the young startups through.
Jeff, I think we wanted to get to the juicy part and get an expectation. I know it's very hard to do this, especially with early stage businesses that require a lot of things to happen to become successes. But in terms of returns and hit and miss ratios, what's your sort of expectation going forward with a portfolio of, say, 20 companies?
Well, I think, like I say, we want to have portfolio spread, which will obviously help with the risk over diversified industries and blend of different companies at different stages. Typically what happens is you have one or two great performing outliers which can give you huge returns, and typically the skill is to try and get as little dogs as possible in the portfolio. But we as a average, we're looking to return 3 to 5 times money over the investment period, which is probably between 5 and 7 years, and we're looking to attain an IRR of between 28 and 38%.
Right,
got you sold yet, Bronwyn?
Yeah, I'm sold. What do you expect the competitors to do at this point?
Well,
we see lots of VC trusts.
We encourage that for other companies to set up these type of trusts. We encourage in angel networks, we encourage investments into the VC space because it's all going to benefit South Africa, job creation, and I mean the latest GEMS report shows that we have the lowest entrepreneurial rate in I think in the world, one of them anyway. And this will definitely help because the access to capital and skills.